This might be my last upload. Please watch carefully. This might be my last upload. Please watch carefully. What you're about to hear isn't speculation. It's pattern recognition. Over the past 72 hours, something shifted. 3 financial education channels disappeared. No warnings, no explanations. Just gone. Each one had covered the same topic within days of each other. The same topic this channel analyzed exactly 1 week ago. The algorithm doesn't glitch this consistently. The timing doesn't align this perfectly by accident. And the content that triggered it reveals something far more critical than platform policy. It reveals what they don't want you to know before the window closes completely. Welcome to Financial Crisis Explained. If you've been following economic patterns, if you understand that information itself has become a strategic asset, then you're in the right place. Now, I need to ask you something important. You know how your grandfather used to say, write it down before you forget it? Well, this channel might not be here tomorrow, so do me a favor, hit that subscribe button right now. Not for me, but because what we discuss here, you won't find being discussed freely for much longer. And before we go any further, drop a comment below. Tell me where you're watching this from. Are you in the States, Europe, Asia, South America? Because what's happening, it's not just happening in one place, it's coordinated, and it's global. Now, let me show you exactly what I mean. The financial education space on digital platforms has always operated in a gray zone. Not quite news, not quite entertainment, somewhere in between. For years, creators discussed market analysis, investment strategies, economic policy without significant interference. But something changed in late 2023, and by early 2025, the pattern became undeniable. Between January and March of this year alone, 17 channels specializing in macroeconomic analysis received content strikes. 11 of them were permanently removed. These weren't small channels. We're talking about platforms with subscriber bases ranging from 200,000 to over 3 million. Established voices, credible analysts, people who had been operating within platform guidelines for years. Gone. What makes this particularly unusual is the specificity of the content that triggered enforcement actions. It wasn't investment advice. Plenty of channels still operate freely discussing stock picks and portfolio strategies. It wasn't cryptocurrency promotion. Despite increased regulatory scrutiny, crypto content remains largely untouched. The pattern centered on 3 specific topics: central bank digital currency implementation timelines, systemic banking liquidity metrics, and institutional derivative exposure in retail accessible markets. Every single channel that experienced sudden removal or severe restriction had published content analyzing at least 2 of these 3 topics within a 30-day window. The statistical probability of this being coincidental approaches 0. Now, let's be clear about something important. Platform content moderation isn't new, and it isn't inherently suspicious. YouTube, for instance, processes over 500 hours of video uploads every minute. Automated systems are necessary. Human review at that scale is impossible. But automated systems follow patterns. They respond to keywords, engagement metrics, user reports. What we're observing here doesn't fit standard moderation patterns. Standard copyright strikes come with clear explanations. Misinformation flags typically allow for appeals and corrections. Community guideline violations usually involve multiple warnings before termination. These removals, different entirely. Channels receive generic notifications, often citing repeated violations of community guidelines without specific examples. Appeal processes led nowhere. Responses were automated, non-specific. And here's what makes it even more telling: the timing. In February 2025, a mid-sized regional bank in the Midwest experienced a deposit run. It didn't make major headlines. The situation was contained within 72 hours. But 3 financial education channels that had discussed the bank's quarterly filings 2 weeks prior all received strikes within days of the incident. One channel had simply analyzed publicly available FDIC data. Another had compared the bank's derivative book to industry averages, using information from the bank's own investor relations materials. The third had created an educational video explaining how commercial real estate exposure affects regional bank stability without even mentioning the specific institution. All 3 flagged for removal. Now, you might be thinking, maybe these channels violated some technical policy clause. Maybe they crossed a line they didn't realize existed. But here's the problem with that theory. Dozens of channels continue operating, discussing the exact same topics, using identical public data sources without any enforcement action. The difference? Those channels present the information without drawing systemic conclusions. They discuss individual bank metrics without connecting them to broader financial stability questions. They explain CBDC technology without analyzing implementation timelines or economic sovereignty implications. In other words, they provide information, but stop short of analysis, and that distinction appears to be the line. Educational content that empowers viewers to draw their own conclusions remains acceptable. Analytical content that connects data points into coherent warnings triggers intervention. This isn't speculation, it's documented pattern observation. Consider the advertising model that funds these platforms. Financial services companies, investment banks, fintech corporations represent some of the highest value advertising categories. A single financial services advertiser can spend millions monthly on platform advertising. Now imagine you're a platform executive, balancing two competing interests. On one hand, creator content drives user engagement. On the other hand, major advertisers express concerns about content that might reduce consumer confidence in financial institutions. Which interest wins? The answer is becoming increasingly clear. What we're witnessing isn't random moderation inconsistency. It's a systematic recalibration of what constitutes acceptable financial education content. And the recalibration accelerates precisely when economic stress indicators rise. That timing is not coincidental, which brings us to the specific incident that may have crossed the threshold for this channel, and why what happened next changed everything. 6 days ago, this channel published a video, standard format, analytical breakdown, publicly available data. The topic was institutional short positioning in consumer discretionary stocks. Specifically, how certain investment banks had accumulated unusually large short positions against mid-tier retail companies, right before those companies reported earnings. Nothing illegal about discussing this. It's all disclosed in mandatory SEC filings. Any investor with internet access can pull up 13F forms and see exactly what major institutions are betting against. But here's where it got interesting. The video didn't just present the data, it asked a question. A simple question that apparently crossed an invisible line. If these institutions have access to consumer spending data in real time through payment processing networks, and they're positioning against specific retailers weeks before earnings, what does that tell us about consumer health that isn't being reported in official statistics? Within 18 hours of that video going live, something unusual happened. The view count stopped. Not slowed down, stopped. For a channel averaging 15,000 views in the first 24 hours, the video had accumulated 8,000 views in hour 1, then essentially flatlined. The engagement rate showed something even stranger. Comments were appearing. The counter showed 47 comments, but only 12 were visible in the comment section. 35 comments, simply missing. Not flagged as spam, not held for review, just gone. By hour 48, the video had been suppressed from recommended feeds entirely. Subscribers weren't seeing it in their home feeds, despite the notification bell being active. Search results for the exact video title weren't returning the video in the top 20 results. Instead, videos from larger financial news channels discussing strong consumer sentiment occupied the top positions. Now, algorithm suppression happens sometimes. Videos underperform, engagement drops. The system deprioritizes content, but this wasn't underperformance. The like-to-view ratio was actually higher than channel average, 7.3% versus the usual 5.8%. Average view duration was 92%, meaning people were watching almost the entire video. Every algorithmic quality signal was positive, yet the video was being actively buried. Then, day 3 brought something different, an email notification, not from YouTube's standard policy team, but from what appeared to be a specialized review division. The email stated that the video was under review for potential economic misinformation and had been age-restricted as a precautionary measure. Age-restricted. A video analyzing public SEC filings, treated the same way platforms handle graphic violence or adult content. The reasoning provided was vague. Content that may present unverified claims about financial institutions or economic conditions. Except every claim in the video was verified. Every data point sourced directly from regulatory filings. Every conclusion presented as analysis, not fact. This is when the pattern became personal rather than observational. Because here's what most people don't understand about content platforms. They don't operate on consistent rule enforcement. They operate on risk management. And right now, the risk isn't coming from users. It's coming from pressure points that most creators never see. In January 2025, 3 major financial institutions quietly updated their advertising contracts with digital platforms. The updated language included clauses about brand safety in relation to economic content. Translation, they reserve the right to pull advertising spend from platforms that host content deemed detrimental to consumer financial confidence. These contracts represent billions in annual advertising revenue. For platforms, Losing that revenue isn't an option. So what happens when a video using entirely public data connects dots that major advertisers would prefer remain unconnected? The video gets classified as risky, not false, not misleading, just risky. And in the risk management equation, creator channels are expendable, advertising relationships are not. But here's what made this situation cross from concerning to critical. 2 other channels, covering completely different aspects of finance, reported identical suppression patterns within the same 72-hour window. One channel had analyzed commercial real estate loan maturities at regional banks. Another had examined the timeline for potential CBDC rollout based on Federal Reserve white papers, different topics, different creators, different audience demographics, but the same suppression signature. Age restrictions applied without clear policy violations, comment sections showing count discrepancies, algorithmic deranking despite positive engagement metrics. And all 3 channels had one thing in common. They'd published content that connected institutional data to conclusions about systemic economic stress, not predictions, not fear-mongering, but just analysis. Analysis that apparently wasn't acceptable anymore. The question isn't whether this suppression is coordinated. The evidence makes that clear. The question is, why now? What specifically about the current economic moment makes this type of analysis dangerous enough to warrant systematic removal? And the answer to that question reveals something far more concerning than platform policy. It reveals what the data is actually showing beneath the surface of official narratives and why that information is being treated as a threat. There's a reason certain information gets buried, and it's rarely because the information is false. Usually, it's because the information is accurate, but inconvenient. What we're about to discuss isn't conspiracy theory. It's publicly available data that simply isn't being connected in mainstream discourse. And when independent creators attempt to connect it, they face the consequences we've already outlined. So let's examine what's actually in the data and why it's being treated as sensitive content. Start with corporate debt. Between 2020 and 2022, corporations took advantage of historically low interest rates to issue bonds at yields averaging 2.4%. Standard financial strategy. Borrow cheap, invest in growth, refinance before maturity. Here's the problem. Those bonds are maturing. Over $1.7 trillion in corporate debt comes due between now and the end of 2027. That's not speculation. That's maturity schedule data from Bloomberg Terminal accessible to anyone with a subscription. But here's what changes the equation entirely. Those corporations now face refinancing in an interest rate environment where comparable bonds yield 6.8 to 7.2%. The math is straightforward. A company that borrowed $500 million at 2.4% was paying $12 million annually in interest. Refinancing that same amount at 7% means $35 million in annual interest payments. That's a $23 million increase every single year, just to service the same debt. For profitable, cash-generating companies, that's manageable if painful. But for companies that were already operating on thin margins, or those that use the borrowed capital for buybacks rather than revenue generation, the equation doesn't work anymore. Defaults aren't a possibility. They're a mathematical certainty for a subset of these borrowers. Now, ask yourself a question. Why isn't this being discussed prominently in financial media? Why aren't major networks running ongoing coverage of the corporate debt maturity wall? The answer is the same reason content creators get suppressed for discussing it. Because once the public understands the scale, behavior changes. Investors start questioning equity valuations, consumers reduce discretionary spending in anticipation of layoffs. The confidence that holds the system together begins to crack. And confidence is the only thing preventing a self-fulfilling crisis. Now let's connect this to the regional banking situation. In March 2023, Silicon Valley Bank collapsed. The narrative presented to the public focused on mismanagement, poor risk controls, concentrated depositor base. All true, but incomplete. What wasn't emphasized was the balance sheet reality facing hundreds of similar institutions. Regional and community banks hold approximately $2.9 trillion in commercial real estate loans, office buildings, retail centers, apartment complexes. Those loans were underwritten, assuming certain occupancy rates, certain rental income levels, certain property valuations. Every one of those assumptions is now broken. Office occupancy in major metropolitan areas sits at 58% of pre-2020 levels. Retail foot traffic has permanently shifted toward e-commerce, and property valuations are beginning to reflect the new reality. When a commercial property was valued at $50 million and generated rental income supporting that valuation, a $35 million loan against it seemed conservative. But when that same property now generates 30% less rental income and comparable sales suggest a market value closer to $38 million, Suddenly, that $35 million loan isn't conservative anymore. It's underwater. Multiply that across thousands of properties. You're looking at hundreds of billions in impaired loans sitting on regional bank balance sheets. The banks know this, regulators know this, but as long as the loans are classified as performing, meaning borrowers are making payments, the banks don't have to mark them to market value. They can pretend the collateral is still worth what it was in 2019. This is called extend and pretend. And it works until it doesn't. The moment a significant percentage of these loans actually default, banks have to recognize the losses. And when losses are recognized, capital ratios fall. When capital ratios fall below regulatory thresholds, banks face restrictions. And when banks face restrictions, lending contracts. We're not talking about isolated incidents. We're talking about a structural problem affecting the entire regional banking sector. But here's where it connects to the content suppression pattern. Videos analyzing bank quarterly filings, examining loan loss reserves, comparing current reserve levels to historical default cycles. Those videos get flagged, not because the analysis is wrong, because the analysis is correct, and public awareness accelerates the timeline. If depositors understand the risk, they move money to larger institutions. If businesses understand the risk, they secure credit lines elsewhere. The awareness itself creates the crisis, so the information gets managed. Educational content remains acceptable, as long as it doesn't connect to systemic conclusions. Individual data points can be discussed, as long as the pattern isn't assembled. Now add the third element, central bank digital currencies. 14 countries have already launched CBDCs. Another 32 are in advanced pilot phases. The technology isn't theoretical anymore, it's operational. And the implications are being carefully managed in public discourse. A CBDC isn't just digital money, it's programmable money. Money that can have conditions attached. Expiration dates, spending restrictions, location limitations. The efficiency arguments are real. Reduced transaction costs, financial inclusion, faster settlements. But the control implications are equally real. And those implications rarely get discussed in mainstream analysis. When independent creators analyze implementation timelines, examine central bank white papers, discuss the infrastructure being built, the content gets classified as speculative, even when sourcing official documents, because once people understand what's being built and how quickly it's moving forward, questions get asked that institutional powers would prefer remain unasked. What we're witnessing isn't random content moderation. It's systematic management of economically relevant information. The data exists publicly, verifiably, but the connections between data points, the systemic conclusions, the timeline implications, those are being treated as dangerous, not false, dangerous. And that distinction tells you everything about what's actually happening. The question now becomes, what does a content creator do when telling the truth becomes a platform violation? Because they trusted platform storage without maintaining independent backups. Fourth, build direct relationships with your audience. This is harder, more time intensive, but infinitely more valuable. A viewer who watches your content through algorithmic recommendation is a platform relationship. A viewer who deliberately seeks out your content, who joins a mailing list, who participates in direct communication, that's your relationship. Those people don't need an algorithm to tell them what to watch. They'll find your content wherever it exists. For business leaders, the parallel is obvious. Customers acquired through platform advertising are platform relationships. Customers who engage directly, who opt into your communication, who make repeat purchases without algorithmic prompting, those are your customers. And in an environment where platform access can be revoked, owned relationships become the most valuable asset you have. Now, let's address the elephant in the room. Why go through all this effort? Why not just adjust the content? Stay within the acceptable range. Avoid topics that trigger suppression. Keep the channel operational. That's a valid question. And for some creators, it's the right answer. But here's the problem with that approach. The acceptable range keeps narrowing. Topics that were fine 6 months ago, trigger flags today. Analysis that was considered standard gets classified as speculative now. If you adjust to today's boundaries, you'll need to adjust again in 3 months, and again 3 months after that. Eventually, you're not creating analytical content anymore. You're creating entertainment, dressed up as education. And for audiences who need actual analysis, who are trying to make informed decisions in an increasingly complex economic environment, that's worthless. There's a reason this channel exists. There's a reason tens of thousands of people watch this content. Because somewhere between mainstream financial media and conspiracy theory channels, there's a gap for serious data-driven analysis that doesn't pretend systemic risks don't exist. And that gap is being systematically closed, so the decision becomes clear. Either you build infrastructure that allows you to continue operating outside platform dependency, or you accept that the work stops when the platform says it stops. For this channel, that decision has already been made. Backup systems are operational. Email infrastructure is built. Content archives are maintained. Alternative platforms are established. If this channel disappears tomorrow, the work continues. Not because of idealism, because of preparation. And if you're watching this, as a business owner, an entrepreneur, someone who depends on digital communication to reach customers or stakeholders, you should be making the same preparations. Not because platforms are evil. They're not. They're businesses, operating according to business logic. But that business logic increasingly conflicts with open economic discourse. And when conflict arises, platforms will choose revenue every single time. Your job isn't to change that reality. Your job is to operate successfully, despite that reality. This might be the last video you see from this channel on this platform. It might not be. But either way, the information will continue. The analysis will continue, just not necessarily here. And if you want to ensure you don't lose access, the time to build that connection is now, not when the channel is gone, not when the platform makes the decision for you. Now. Because in the environment we're moving into, the only communication infrastructure you can trust is the infrastructure you control. Everything else is borrowed time. When the infrastructure you depend on becomes unreliable, you build new infrastructure. That's not activism. That's basic risk management. And right now, any creator or business leader relying solely on platform-mediated communication is operating with a single point of failure. Let's be direct about what's happening. Platforms are becoming gatekeepers, not just of distribution, but of acceptable economic discourse. And the acceptable range is narrowing. This isn't a temporary policy shift that will reverse when leadership changes or public pressure mounts. This is structural realignment, driven by financial incentives that aren't going away. Advertising revenue will always outweigh creator relationships. Institutional partnerships will always supersede individual voices. That's not cynicism, that's the business model. So the question isn't whether platforms will protect independent financial analysis. They won't. The question is, what do you do about it? First, understand the timeline you're operating within. Based on the pattern escalation we've documented, full-scale suppression of systemic economic analysis will likely be normalized within 6 to 9 months. Not banned outright. That would be too obvious. Instead, algorithmic suppression will become so severe that the content effectively doesn't exist. Age restrictions, search deranking, recommendation feed exclusion, shadow limiting. Death by 1,000 cuts rather than outright removal. Which means you have a window, a narrow window, to build communication infrastructure that doesn't depend on platform permission. Let's talk about what that actually means. Email lists, yes, it sounds basic, outdated even, but email is the only digital communication channel where you own the relationship. Platform algorithms control whether your content reaches your audience. Email, you control directly. If you have 10,000 email subscribers, you can reach 10,000 people, regardless of what any platform decides. That's not true for followers, subscribers, or connections on any social platform. Those relationships are leased, not owned. The platform can revoke access at any moment. For business leaders and entrepreneurs watching this, the lesson is identical. Customer communication that flows exclusively through platform messaging, advertising systems, or social media can be severed instantly. One policy change, one algorithm update, one advertiser complaint, and your primary communication channel disappears. Building an owned email database isn't optional anymore. It's fundamental business continuity. Second, decentralize your content distribution. Multi-platform presence isn't about reach, it's about resilience. If this channel disappears tomorrow, the content exists in 5 other locations, different platforms, different jurisdictions, different corporate structures. Some platforms are more resistant to institutional pressure than others. Smaller platforms, decentralized protocols, RSS-based distribution. These aren't as convenient, they don't offer the same reach, but they offer something more valuable right now. Reliability. Third, archive everything. Content that only exists on a platform server doesn't really exist. It exists until it doesn't. Download your content. Store it locally. Maintain backup copies in multiple locations. This isn't paranoia, it's data management. Creators who lost channels in the recent suppression wave lost years of work, thousands of hours of research, analysis, production, gone.